Imagine Jack has $200,000 sitting in cash, and he wants to put that money to work. But instead of putting everything into one investment, Jack decides to spread his money across 5 different Fidelity index funds. At first, this sounds simple, but here's where things get interesting. The exact same $200,000 can produce completely different results depending on how Jack divides it. One strategy can be designed to generate a powerful stream of dividend income. Another can focus almost entirely on long-term growth. Same starting money, same 5 funds, but a completely different financial future. So, what should Jack actually invest in? And more importantly, how much should he put into each fund? That's the real question. Before we get into the portfolio, Jack needs to understand what each investment is supposed to do. Because a strong portfolio isn't just a random collection of funds. Every part has a job. The first job is stability. Jack needs something that can act as the foundation of the portfolio and give him exposure to America's largest and most established companies. The second job is growth. He wants another investment that puts more weight on technology and companies with the potential to grow faster. The third job is opportunity. Jack wants exposure to smaller companies that could potentially become tomorrow's market leaders. The fourth job is income. This part of the portfolio is designed to produce dividends that can eventually create a stream of cash flow. And the fifth job is diversification. Jack doesn't want his entire financial future to depend on a single country or economy. That's where international and emerging market investments come into the picture. Together, these 5 roles create a portfolio that is designed to do more than just grow. It's designed to balance growth, income, opportunity, and diversification. Now, if you're new to investing, there's one important concept Jack needs to understand. An index fund is essentially a basket of stocks that follows a specific market index. Instead of trying to guess which individual company will become the next big winner, Jack gets exposure to many companies at once. That can make investing simpler and more diversified. And because these funds are designed to follow an index rather than rely on constant stock picking, they can also be relatively inexpensive to own. But here's the important part. Choosing 5 good funds is only the beginning. The real decision comes later. Because Jack can take these exact same 5 funds and build to completely different portfolios. One can be tilted toward income. The other can be tilted toward growth, and that difference could completely change what his $200,000 becomes over the next 30 years. So, let's start with the 5 funds Jack is considering, and see exactly what job each one is designed to perform. Now that Jack knows what each part of his portfolio needs to do, it's time to look at the 5 funds more closely. And he starts with the foundation, the fund that holds everything together. For Jack, that role belongs to a broad U.S. large-cap index fund. Think of it as the base of the entire portfolio. This type of fund gives Jack exposure to hundreds of America's biggest companies across technology, healthcare, finance, consumer brands, and many other industries. Instead of trying to guess which company will perform best, Jack gets a piece of the entire market. That's why this is the anchor. If the portfolio is a house, this is the foundation underneath it. But Jack also wants more growth potential. That's where the second fund comes in. This one has a much stronger connection to technology and innovation, giving Jack greater exposure to areas like artificial intelligence, cloud computing, software, and semiconductors. The potential upside is clear. When technology companies grow rapidly, this part of the portfolio can grow faster too. But there's a trade-off. The same concentration that can accelerate growth can also increase risk. When technology stocks perform well, this fund can move quickly. But when technology falls, it can feel the pressure more than a broad market fund. That's why Jack doesn't want it to become his entire portfolio. He wants it to be the engine. The foundation provides stability. The technology fund pushes for growth. But Jack still has another question. What about the companies that haven't become giants yet? Every major company started somewhere. Today's market leaders were once small businesses trying to grow. That's where the third fund comes in. A small cap index fund. Instead of focusing on America's largest companies, this fund gives Jack exposure to many smaller businesses. Most of them may never become household names. Some may struggle, but a few could potentially grow into tomorrow's market leaders. That's the bet Jack is making. He's not expecting every small company to succeed. He's simply giving his portfolio exposure to the possibility that some of them might. So now Jack has three important pieces: the broad market foundation, the technology growth engine, and the small company opportunity. But two major pieces are still missing: income and international diversification. And those two pieces could become extremely important when Jack starts building a portfolio designed specifically for long-term passive income. That's where the final two funds enter the story. Now Jack has three important pieces of his portfolio in place. The first is the broad US market, which gives his portfolio a strong foundation. Instead of depending on just a few companies, this type of investment gives Jack exposure to many of the largest businesses in America. The second piece is the technology-focused fund. This adds another layer of growth potential to his portfolio. Technology companies have played a major role in the market's growth, and Jack wants some extra exposure to that part of the economy. The third piece is the small cap fund. This one is different from the first two because it focuses on smaller companies that haven't yet become major market leaders. Jack knows that not every small company will become successful, but some of today's biggest companies were once small businesses too. By including this fund, Jack is giving his portfolio a chance to benefit from companies that could become tomorrow's leaders. So far, Jack has a solid mix of stability, technology growth, and future opportunity. But Jack still needs two important pieces to complete his five-fund portfolio. The fourth piece is international exposure. Jack doesn't want all of his money to depend on the performance of the US market. History has shown that different countries and regions can perform differently over time. By adding an international index fund, Jack can gain exposure to established companies in countries such as Japan, the United Kingdom, Germany, Switzerland, and Australia. The fifth and final piece is emerging markets. These are economies that are still developing and expanding, including countries across Asia and other parts of the world. These markets can be more unpredictable, but they also offer the potential for long-term growth. Now Jack has all five pieces of his portfolio in place. He has a US market foundation, a technology growth engine, exposure to smaller companies, international diversification, and emerging markets. But choosing the five funds is only half the strategy. The real question is how much money Jack should put into each one, because the same five funds can create two completely different portfolios depending on how Jack divides his money. Now Jack has all five funds selected, but choosing the funds was the easy part. The real decision is how he divides his $200,000 between them. Jack has two completely different goals in mind. The first goal is income. He wants a portfolio that can generate a growing stream of dividend payments over time. The second goal is growth. He wants to build the largest possible portfolio over the next 30 years. The interesting part is that Jack can use the exact same five funds to pursue either goal. The difference comes down to one thing: the percentage he gives to each fund. For the income-focused portfolio, Jack puts the largest portion into the international fund. This fund has a higher dividend yield than the others, so it becomes the main income-producing part of his portfolio. Next, Jack adds a meaningful position in the emerging markets fund. The goal here isn't just current income. Jack also wants exposure to dividend growth that could potentially increase his future income. Then he adds the S&P 500 fund as the foundation of the portfolio. This gives him exposure to America's largest and most established companies. The technology-focused fund receives a smaller allocation. Jack still wants growth, but income remains the priority. Finally, he gives the smallest portion to the small cap fund. It's the most speculative part of the portfolio, so Jack keeps its weight limited. This creates a portfolio designed to generate income while still keeping some room for long-term growth. But Jack's second portfolio takes a completely different approach. This time, income is no longer the main priority. Jack wants to maximize the potential growth of his $200,000 over the next 30 years. So he flips the strategy. The technology-focused fund now receives the largest allocation. Jack is putting more of his money toward the fund with the strongest historical growth potential in this portfolio. The S&P 500 remains an important part of the strategy, because Jack still wants a broad foundation built around America's largest companies. The small cap fund also receives a larger position. Jack is willing to accept more uncertainty in exchange for the possibility that some smaller companies could become major businesses in the future. The emerging markets fund stays in the portfolio, but with a smaller allocation, and the international fund, which was the biggest piece of the income portfolio, now becomes the smallest position. The result is a completely different balance. The income portfolio puts more emphasis on dividend payments and diversification outside the United States. The growth portfolio puts much more emphasis on American companies and long-term price appreciation. Same $200,000, same 5 funds, but completely different results can come from simply changing the weights. And this is where Jack's real decision begins. Does he want a portfolio designed to pay him more income along the way? Or does he want to focus on building the biggest possible account for the future? The answer depends on what he wants his money to do. Now Jack has built his income-focused portfolio. The goal is simple. He wants his $200,000 to grow over time, while also creating a potential stream of dividend income. But what could this portfolio actually look like after several decades? Using the assumptions in this example, the first few years may not look very exciting. After the first year, the portfolio could grow to around $226,000. That's a solid start, but it doesn't look life-changing yet. The real power comes from giving the investments enough time. After 10 years, the portfolio could potentially grow to around $669,000. By year 20, the projection reaches more than $2 million. And then something interesting happens. The longer Jack stays invested, the more powerful the compounding effect becomes. By year 30, the income-focused portfolio could potentially grow to around $6.5 million. But Jack isn't only interested in the final account balance. He's interested in what the portfolio could potentially pay him. Based on the assumptions used in this example, the portfolio could eventually generate more than $7,000 per month in dividend income. And the important part is that Jack isn't planning to sell his investments every month to create that cash flow. The idea is that the companies and funds themselves are generating income. Jack owns the investments. The investments generate dividends, and those dividends can potentially provide him with a regular source of cash. That means Jack could potentially live from the income while keeping his original investments working in the market. Of course, this is a projection, not a guarantee. Dividend payments can change. Stock prices can fall. Markets can go through long periods of weakness. But the strategy is built around one powerful idea. Give your money enough time to compound, and even a large amount of wealth can potentially grow from a relatively modest starting point. Now Jack has to think about what happens if he chooses the growth-focused portfolio instead. Remember, the 5 funds haven't changed. The only thing that changed is how Jack divided his $200,000. This time, the technology-focused fund gets the largest allocation. The goal is no longer to maximize current dividend income. The goal is to maximize long-term growth. The S&P 500 remains an important part of the portfolio because Jack still wants exposure to America's largest companies. The small cap fund also receives a larger position, giving Jack more exposure to smaller businesses that could potentially become future market leaders. International and emerging market funds remain in the portfolio, but they receive smaller allocations. The result is a portfolio that is much more focused on growth than income. And this is where the numbers can become very different. Based on the assumptions used in this example, the growth-focused portfolio could potentially reach around $12 million or more after 30 years. That's dramatically larger than the income-focused portfolio. But there's a catch. The larger portfolio doesn't necessarily produce the same amount of dividend income. In fact, its dividend income could be much lower. So Jack now faces an interesting trade-off. The income portfolio could potentially give him a smaller account with a much larger stream of dividends. The growth portfolio could potentially give him a much larger account, but with less natural dividend income. Same $200,000, same 5 funds, 30 years of investing, but to completely different outcomes. And now Jack has to decide which result matters more. Does he want a portfolio that potentially pays him more directly through dividends? Or does he want the largest possible portfolio and the flexibility to decide later how to use that wealth? That's the decision that turns a collection of investments into an actual financial strategy.